All right, ladies and gentlemen, I hope you had a wonderful day. We got a lot to talk about. It was a wild one. The S&P went higher than February 1st, 2023. That means it's a new high for the year. It's not a 52-week high, but the NASDAQ hit a 52-week high today, and it is all off of the optimism on the debt ceiling. Who would have thought the most bullish events this year would have been a banking crisis, the earnings not being that bad, and now positive views on the debt ceiling? It's looking good. So listen, man, when I'm wrong, I am wrong, okay? Because I thought we weren't going to move much, and now 2 days later, we're breaking out of the range. This is pretty wild, and now it is leading into an important weekend. Now, if you were on stream, we talked about it a lot. I got a couple of updates for you, so I'll probably talk about this tomorrow on stream, youtube.com/thestockmarket. Hopefully we see you there, but it's going to get interesting. This weekend may not be as crazy as we are expecting. However, I have a outcome and really the next issue that the stock market is going to be worrying about, and that will be the Treasury refunding. So remember, we brought this up. We're getting these daily Treasury statements. It looks like it dropped to the lowest level today since 2021, again around 62 billion, but seeing as where the Treasury balance is, if there is a positive deal, if they do come to any agreement, the Treasury is going to try to get this balance up, and they're going to sell a ton of bonds. So that's what I want to talk about today. It's going to be the next step, but let's run through a little bit about the craziness of the day. You guys have to see this. So let's start off with the morning. We had a little bit of a gap up. There was the Alibaba earnings, and it was a little softer. Even if you saw Alibaba this morning, it looked like it didn't react. And right when it opened, it did bad. And the China stocks did bad, and the Chinese Yuan went above 7. Now, I'm going to come back to this. That is very important, and I'll show you why. But in the morning, you had that. Then the initial jobless claims, it actually came in a little weaker than expected, but market didn't really like that. The bonds reacted immediately, and then at the same time, we heard from Fed Logan. She said that she does not see even a pause. It was very hawkish, even Buller. They were speaking very hawkish towards all of it. Rate hike odds for the pause. That's starting to balance out a little bit. I closed out yesterday on the other trade, even my other bond one. I thought it wouldn't move this much. Like I'm saying, I reacted with my money too, but it started to move very, very wide today, but that was all part of it. But now it was all the deal optimism. We were dumping in the morning off the hawkishness, off of the job claims, but then things opened up and the deal optimism was very heavy. Walmart earnings, again, as far as anything that was bad, the Walmart earnings were better than expected, and put that against the backdrop of all of the bad Home Depot and Target, even though Target just dumped. They actually absolutely dumped today, but Walmart was good, and that optimism, it really distracted from all of it. So we were bouncing up. We came down at one point now, and this is where it gets interesting because, as you see, we started to drop, and right after we drop, you see that little drop and pop, that second one. That was now the development that we got on the day. Most of the day was deal optimism. We actually dropped right before Kamala Harris came on. Even Yellen spoke to a bunch of people, but we listened to Kamala and Lael Brainerd, and they were talking about the deal, urging leaders about the warnings of the effects and saying how Congress needs to get a deal done. So we were dropping before that, but then this pop right here was Mr. McHenry. This is Patrick McHenry, bow tie man. You've seen this guy. We've listened to him, and that's because he is the financial services chairman, and he said that they are not close to being done with the deal. And then we started to drop. That was after the earlier drop, and then we kind of chilled out a little bit. But here's the development I said from earlier today. We were talking about, okay, it's all about the weekend, all about the weekend. He said at that moment, and this is why the market was dropping too, but he said they would not commit to a plan or even an outline by the weekend, but he said the right things are being discussed. So he was kind of warning and tempering against the weekend deal, and then he kind of softened it up a little bit. So that's why I'm saying maybe this Sunday, especially with how we closed, maybe the market will be accepting of that. That's really what we got to be looking out for. So that was the big update throughout the day. But again, we were already up. And then even Senator Sinema, she was saying things about a deal. Again, they were all kind of saying good and bad at the same time, but overall the optimism remained, and even from the morning it was already spreading throughout Europe and everything was good, and then we squeezed into the end. So that's what we had today, and that's why now tomorrow, Jerome Powell, 11 a.m. Eastern, we'll see what he says, and we'll see if he wants to bat it down. Last time he had the opportunity, it was unique, and now before I tell you about the next big issue in the refunding, here's that other thing I wanted to show you. In the midst of it, China stocks did bad. And since we're bringing up Jerome Powell and these levels, you see this September pop. Well, this little pop and drop and everything. Last time we saw the market move like that, well, you had the Chinese Yuan above 7. And we talked about this a lot today, and there's a little bit of lag. And here is it overlaid now with the S&P. But anytime it's gone above 7, we have had problems. And even again, this year or last time it happened, it was around this September rally. So even though we're hitting highs and we are still worried about the debt ceiling, this is going to make sense with what we got to watch out for, because now if any of this falls apart, I just think we're about to get very, very volatile from here. Otherwise, we could put this on the back burner and now worry about the things in the future, and then we'll see if things like China, the dollar, and the bonds, if these become important, because again, things like China were moving, people were pointing out the dollar, and now everyone's like, wait, what is happening? And again, that deal optimism is very, very heavy, not to mention what the other tech stocks have already done post-earnings so far, and a little bit of good Walmart to calm down the consumer so far. But that's what we have, and now let us talk about the next issue, the next thing that we have to be watching for. Like I said yesterday, do not underestimate the market's ability to start looking for the next thing. So we're moving a little bit faster than I thought, but like I'm saying, this kind of flows into the outline that I gave yesterday, where the market will be able to start waiting for the next thing, and depending on how this debt ceiling pops or plays out, it might give us a little bit of pop, but we have to see now what is the next thing. So we talked about the PCE, and that's for next Friday, but now this next thing, if there is a deal agreement and we get a deal this weekend, assuming we do, granted, like I'm saying, they kind of seem like maybe tomorrow they're going to signal that they're going to get stuff voted on next week, and we'll see how the market takes it. But if they get a deal this weekend or whenever, if a positive agreement is made on the debt ceiling, the next step, the next thing that the Treasury will do is they will start to refund their balance sheet, and they will go to sell bonds to refund all of the money that was depleted. So right now, like we said, it's looking to be around $700 billion they're looking to refill, because the current balance is standing at $62 billion. So think about it if you're not getting it so far. Right now, the problem is why we're freaking out. There's no money in the Treasury. They have no way to get more money, and they have big payments that are due on June 1st. If we don't have enough money in the Treasury balance and can't pay those payments, you default on your debt. Everybody freaks out. First time in history, right? So that's where we're at. But now, if they have no money, the deal goes through and it gives them a way to get more money, and now the Treasury could have a bunch of money. That's exactly what they're going to do, and immediately they will sell a ton of bonds to get that money. So it could be $1 trillion. Right now it's standing at $700 billion, but this is where things get interesting, because now if this happens and there is an agreement, Treasury goes to refund and get all of their money back, the bond yields will most likely start to run up, aka TLT, IEF go down. So keep in mind, in the midst of all of this, this is only one factor for the bonds. This is where the last couple of months makes things a little bit confusing because the bonds are also reacting to this risk on, risk off from the banks and whatever else is happening. Again, using it as a safe haven as well as the Fed expectations. Both, are they going to stay higher for longer or no? We think the Fed is going to pivot again back to the recession stuff. So all of that's weighing on the bonds, but simply selling $700 billion of bonds, that's probably going to weigh on the markets, and that should theoretically bring the yields up, and we'll see how those other factors play out. And really my theory on this now is that would be good for the markets temporarily. Markets get a deal, they like it for a little bit, but then if the yields go too high, which they probably will, and then people will start freaking out, and then that stops the rally, and then we start reacting to the other stuff, and that's where we could get this environment where we kind of pop a little bit and then start reacting to the next data sets. However, if it does end up very good and the yields don't go up too much, that could be your narrative. And if people really want to ride the bullishness, they will ride this bullishness straight to 4,300, and that'll be good for the next couple of weeks until you get into Powell. But we'll see. I'll adjust it. And again, as not moving, hitting all-time highs, I could be wrong. We'll see what happens. But that's, again, this is all if there is an agreement. But now, what happens if there isn't a deal? Let's assume there's no deal this weekend or a negative development. Again, if they can't pay the money and they never agree to anything by June, we default. Everything goes poo-poo. Again, that's what, Kamala was saying today. But if there's no deal met, no good development over the weekend, the bonds will likely get bid, yields will go down, aka IEF, TLT will shoot up, and then even the same thing for all the other hedges, gold, the yen, and all of that. And then we will start to watch the market respond to the debt ceiling a lot more. And that's now what we've been saying here, because after this weekend, it's now 2 weeks ahead of the event, and whether you realize it or not, we're hitting all-time highs, but this catalyst is the debt ceiling, and we're reacting off of it turning out to be good, and some of the optimism amongst some of the other things, post-earnings and all of that. But the point is, we're actually moving. If there's negative developments from here on out, we may start to see equal and opposite reactions. So we're going to see what happens, and really to sum it all up, all of this and even the refunding thing, it's important, but it's helpful and it's not. Unfortunately, we don't know what's going to happen with the deal, so we don't know when the refunding is going to happen, and even when it does occur, there's going to be a lot of variables. But now, depending on whatever happens or what you think is going to happen, you could lean in which direction. That's the beauty, seeing what could potentially happen. You could lean into it if you have your own idea. Again, none of this is a recommendation. That's all up to you, but this isn't one of those scenarios where it's like, okay, bonds have to go up no matter what, bonds have to go down no matter what. Eventually and hopefully this year we do get that scenario, but the good part of this is that we know what the next issue is going to be. We know when it will happen, pretty much right after we get a deal or don't, but it could drive a very important part of the market, and that's the bonds. And then the second half, and whether or not we see a correlation, do interest rates, do they weigh on tech or not, and how does everybody take this, and then Powell and everything else. So I think it's going to be very interesting. As far as how I'm playing it, like I said, the only thing I got now is gold. I'm getting crushed on it a little bit. I closed out my bond play. Like I said, I put my money where my mouth is. I thought it was going to kind of stay a little bit more stable on all fronts, but market is loving these updates. So we're going to see. But for now, the only play I got on it is gold, and I'm either going to position tomorrow. I'm thinking either a straddle, or realistically, I'm leaning more. I'm like 60-40, leaning more towards wait till Sunday night and see what we get, because like I'm saying, after these updates here, and just even from Mr. Sherman, or what's his name, McHenry, I just think the market might be ready to handle nothing on Sunday. We're going to have to see, but then again, Mr. Jerome might be able to help us out tomorrow too. So for now, either straddle or nothing and waiting till Sunday night to make the play, and then we're going to see. But if you did put a gun to my head and you did want to make me decide, I would actually be on the downside of bonds, simply playing if nothing bad ever happened here, and the only logic would be if the Fed said that they might want to go and raise rates again, or that they're not going to pause. That's it. Just the unwind of what Powell doesn't want to see, the market pricing it in. So there is some favor on the bonds, but the bonds are heavily shorted right now, and this is very debatable. Again, that's only if you put it to my head. But Chad, that is all. I hope it helps you. You let me know, but that is your watch list, ladies and gentlemen. Make sure Hydrate Healthy ready to go. Make sure you post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, you have time, and in the stock market, you didn't know this was the philo. Everything's being sold to you, my friend. Do you believe it or not? Everything is as far as you are willing to accept it. Your dollar is based on perception. So, Chatadonia, take that as you please. It's another philo, even on context. We could talk about the background too, but take it all in, and I hope you get some of what I sprinkled in this video. We are talking about the second half. It's very interesting where we're at right now. Let's see what happens, but sell in May and go away. I don't know. We're about to have summer and all that, Chad, but let's see where you're at. But you already made it this far. But, Chad, I love you. I will see you in the morning. We got Powell tomorrow, so I better see you, but that's it. I love you. I love you. I haven't been awkward. It's awkward here. No bull on this. You see this one? It looked like it was going to have a bull, but it didn't have a bull. No, is that awkward? It's not awkward. Okay, I love you. Horn.